Hello, everybody, and welcome to the Dorsey Wright podcast for the week of September 20th. I'm Jay Greg Nanny, and here joining me this week is Ian Saunders. And we are closing down the month of September as we're recording this on Monday, with the markets being down a couple of percent, depending on the index that you're looking at. And it's coming at a time, we turned the calendar last week, was the last or the second to last triple witching of the year, coming at the end of September. And September historically is a weak month for the market. As a matter of fact, the worst month. 100. We'll look a little bit more at that historical data in a minute. So far, September 2021 started off on a positive note, at least in the first couple trading days, with the S&P 500 hitting, continuing to push to new all-time highs. Intraday getting up to 45.40, but ultimately on the September 2nd, closing around 45.36. However, since that time, it's been a relatively weak month of September after those first couple of trading days, which is not uncommon for the month of September. Nonetheless, here we are today as we're recording this, the S&P 500 down 2.5 or 2.6% so far. And what we wanted to do is not only provide a little bit of historical perspective as it relates to the month of September and kind of recap some of that, but also provide some insight and some guidance in terms of where certain key areas of support are for the S&P 500, and also maybe which sectors have been weighing the most on that particular index. And as we look at the market today, if we take a step back from a big picture perspective, the S&P 500 is down just the month of September about 4.5%, just shy of 5%. So pretty close to seeing the first 5% correction in nearly a year. You have to go back to last October since we saw the last 5% pullback in the market. And this is something that a lot of people out there have been talking about in terms of the market's overdue for a pullback. It's overdue for correction. It's been over a year and a half since the 10% pullback. And here we are, about a year out since the last 5% pullback, very, very close to that. Would not be surprised to see that happen today or potentially tomorrow. Nonetheless, as we look at the S&P 500 specifically today, the long-term trend remains positive. The long-term bullish support line remains intact. We've seen the S&P 500 chart now give a second consecutive sell signal on its point and figure chart at 44.30, violating some support there. And so as we look at the S&P 500 point and figure chart today, 42.40 would be the next area of support that we would see on that particular index, and then 41.80 would be after that. And that's, in line with roughly where the 150-day moving average is, right around the 42.13 area. So that's, from here, the next area of support is going to be right down in that, call it between 41.80 and 42.40 area specifically. So again, big picture, long-term trend of the index remains positive, and that's not necessarily the case for all stocks out there, but the long-term trend of the S&P 500 index remains positive. But Ian, as we were talking earlier, September historically is a pretty weak month for the market, with the market being down 4.5%. Where does that stack up historically as it relates to September's best?
Yeah, Jay, and I mean, you mentioned that we're down about 4.5% in the month of September, and approaching that 5% level, that 5% pullback level, that has been a frequent topic of conversation across kind of any financial media that they've seen over the course of the past few weeks. Because, like you said, we had not seen a 5% pullback in the broader equity market, the S&P 500, since October of last year. So we're approaching that here today. That the 10% level is also going to be an interesting place to monitor. Should we continue to look toward that? You mentioned those near-term support there at 42.40 and then at 41.80 on that 20-point chart of the S&P. We'd hit a 10% pullback if it did get there at around the 40.83, at least from a closing high perspective, which is also going to be where that May low is, that May support level on that 20-point chart. So a few other kind of interesting support levels to monitor. But when we're looking at historical movement for the S&P, that 4.5% pullback in the month of September is about the seventh worst pullback that the S&P has seen in the month of September since 1987. So interestingly enough, last year, this time, so in the month of September last year, we saw a pullback of almost 4%, so 3.92% during the month of September. So that sits in the 8th position, but years that are going to see more of a substantial pullback for the core market index, you're looking at 1990, 2000, 2011, 2001, 2008, and then 2002. And 2002 is actually the only month since 1987, the only month of September that has seen a double-digit decline in the S&P 500. So certainly not quite there yet. Obviously, if we've seen anything over the past couple of years, Jay, never going to say never. But we still have that strength in the broader domestic equity market does kind of remain intact. Definitely going to be some interesting places to monitor here. As we move through with September, I mean, we see that September is actually one of the, as Jay said, one of the worst performing historical months for the S&P 500. October is also typically a pretty poor performing month on average for the S&P. The worst performance, more single month performance that we've seen in any month to kind of going back to 1987 did come there in October. But we tend to see a little bit more muted, or at least certainly more volatility in the month of October, at least historically as well. But looking forward from there, we've seen a little bit of that volatility begin a little bit before this pullback, Jay, when looking at some of those participation indicators that you and I were taking a look at earlier.
Yeah, and you mentioned, certainly a lot of the longer term indicators, the longer term strength continues to be positive for equities. You look at the long term trend of the S&P is up. You look at things like the percent of stocks within the S&P 500. And, you still see about 80% of those stocks in positive trends today, which historically is still a generally positive number. Numbers above 50% from a longer term perspective are typically positive. It is worth noting that number has declined since April from about 92. So you have seen a number of individual stocks and certain pockets of the market move into negative trends. Some of those pockets being some of the autos, some of the airlines, just, as an example of where you've seen some negative trend changes there. On the shorter term side, though, in terms of looking at that participation, while the market was hitting new highs back at the beginning of September, you were seeing a majority of stocks trading above their shorter term moving averages. And specifically, if you look at just the percent of stocks that are above their 10-week or 50-day moving average, back when the market was hitting new highs, that number was about 70%. So about 70% of the stocks showing positive short-term moving average pictures there. Today, that number has declined to about 44%. So you're seeing, a number of individual stocks violate those short-term moving averages, those shorter-term areas of support. And, as a result, you're seeing just the market has been led and carried higher by just fewer stocks really over the course of the past few months. As you've seen some of that narrowing of the leadership, narrowing of the breadth of the strength within the market, and you're seeing that unfold in some of these shorter and even potentially longer term indicators. But we'll certainly continue to watch and monitor to see if some of the weakness within the shorter term indicators ultimately spills into some of the longer term indicators. Again, as it stands right now, I mean, the market's less than 5% off its all-time high. So it's, I think we're still a ways away from saying that the trend of this market has turned negative. In fact, the trend remains positive from a longer term perspective, but not without some near-term volatility and near-term weakness amongst some of those indicators. And there's been some, sectors, Ian, that have, frankly, been more responsible for some of that weakness that we've seen out there than others have been.
Yeah, absolutely. I mean, we had a bit in the daily report looking last week. I was looking at the percentage of stocks and different respective indices that are at least 10% off of their respective 52-week highs. And we saw a lot more deterioration on the small cap side than we did on the large cap side for a lot of those indicators. But in looking at it from a sector perspective, with large caps being the more kind of generally more favorable technical area really since March of this year, it kind of makes sense. You'd expect to see a little bit more deterioration with some of those small caps names than you would with the large cap names. And we see some of that same theme reflected in some of the movement when looking at the sector perspective. Generally, the stronger technical strength, the stronger technical areas of the market, those areas that have demonstrated more relative strength through rankings such as the Dolly sector rankings, have not seen as many names decline from relative highs. But we have seen some deterioration, specifically looking at areas such as materials, communication services, and then energy, each of which now rank in the bottom half of the Dolly sector rankings. At least 70% of the stocks in each of those respective sectors, looking at the broader NASDAQ mid-large index, at least 70% of the stocks in each of those sectors are at least 10% off of their highs. Areas that have held up a little bit better, interesting, unsurprisingly, utilities don't see quite as much kind of volatility from a lot of those utility names. Technology's held up a little bit better. It's ranked second there in the broader Dolly rankings. But real estate is one of the more interesting names. We're only seeing 28% of the stocks in the broader real estate sector are 10% off of their highs. Don't have quite as many real estate names in that index as we do some of the other sectors, but haven't seen as much kind of absolute deterioration from the real estate space. And that's been another space that's picked up a fair amount of relative strength buy signals over the past few months in that broad Dolly sector ranking. So definitely could be another interesting place to monitor there. Real estate being showing the least kind of absolute deterioration within those individual constituents. But we have seen a fair amount of deterioration kind of across the board, whether you're looking at any of the sectors, regardless of the strength. Each of the average stock in each sector, so the average drawdown from relative high is now at least 10%. With real estate showing the lowest of just 10.55% off its high. The worst being communication services there. You also have sectors such as energy, materials, and then healthcare are also showing a fair amount of deterioration. But definitely those stronger relative strength areas, we've seen less deterioration from there. And you might kind of expect that as we've looked at least historical declines there, Jay.
Yeah. And I think, especially in today's market with, not seeing a ton of downside volatility, frankly, for the past year or so, obviously, save going back to the February, March time period of 2020. But you really haven't seen a meaningful pullback of 5% or more in almost a year now. Things have been generally quiet here, and 5% pullbacks are something that happen with relative frequency. I mean, 10% pullbacks on average in the market are something that would be relatively normal in the context of that happens to the S&P 500 about every year to year and 3 months or so. So, a 10% pullback is certainly something that would be very relatively normal within the context of the overall market. There are historical periods where we've seen that go 2, 3, 4 years in some cases, though. So it doesn't mean that it happens like clockwork every year, but it is certainly something that would be seen as relatively normal. So, with that said, especially in a day like today, I think it's useful, helpful to step back and gain a little bit of perspective on the market, a little bit of perspective in terms of how this pullback relates to, other time periods, and just looking back at some of the historical September specifically, which Ian, you mentioned. I mean, September, October, those 2 months combined are typically among the more volatile months in the market before starting November, which starts what is known as the historically strong seasonal 6-month period in the market. So we've got about a month and a half to get to that point. So we've got some certainly some near-term weakness amongst some of the indicators. So would not be surprised to see some continued back and forth action here within the market. And, not only within the equity market, we've seen this, kind of consolidation across a number of different asset classes, interest rates being one of them, which have, basically traded sideways for the past month or so around the 1.3 to 1.375. The chart of the 10-year yield, as a matter of fact, just reversed back down after hitting that 1.375 level for the fourth time now, reversed back down. So it's got some resistance there. 1.4 would see a breakout on the 10-year yield index, would suggest higher interest rates. However, right now, you're basically just been range bound as it relates to the 10-year yields specifically. So, but with that said, we'll continue to monitor the situation, monitor how this market continues to play out as it relates to not only updating you on key support levels via our daily equity reports and other podcasts and videos, but then also as the indicators play out, how those indicators are shaping up and unfolding, either to the good side or to the downside. Be sure to stay on top of that information. So as always, we appreciate you joining us this week. And Ian, thanks for being on. And if there's anything we can do to help, please don't hesitate to reach out to us. But in the meantime, thank you for joining us. Look forward to talking to you next week.